Hey everyone, and welcome to another deep dive. Have you ever wondered what really makes currencies tick? I mean, we all know they go up and down, but what's the story behind those fluctuations? Today, we're going beyond the headlines to uncover the forces shaping the value of the money in your pocket.
It's a story with twists and turns, booms and busts, and it all connects back to something you might not expect. Commodities.
Okay, let's unpack this. We're diving into Ashraf Laïdi's book, Currency, Trading and Intermarket Analysis. It's a guide to understanding not just how to trade, but how currencies reflect the health of entire economies. Our mission, to equip you with the knowledge to decode the news and understand the forces at play in this intricate global dance.
What's fascinating is that Laïdi shows us how currency trading has become accessible to everyone, not just Wall Street. He says it's increased in size and speed, and that impacts everything from your investments to the price of goods you buy every day.
So no pressure currencies.
Right.
But before we get to today's playing field, we need a little history lesson. Enter the Bretton Woods system. Think of it as the gold standard's more complex cousin.
Okay.
It basically pegged global currencies to the US dollar, which was linked to gold. Why does this matter?
It created a period of relative stability. Imagine a world where currencies were anchored to something tangible, something with inherent value. But like all things in economics, it wasn't built to last.
Right, because eventually the US dollar couldn't carry the weight of the whole world on its own. Laïdi calls the dismantling of Bretton Woods in the 1970s a radical departure. What changed it?
The era of floating exchange rates began, and with it, a whole lot more volatility. Suddenly, currencies weren't just about gold reserves. They became intertwined with a complex web of factors, from interest rates and inflation to government policies and even investor sentiment.
And this is where it gets really interesting, right?
Yeah.
Because suddenly you can't just look at a country's gold reserves to figure out if their currency is strong. It's like the market became a giant, unpredictable game of risk.
Precisely. Laïdi highlights how economic theories like purchasing power parity and interest rate parity attempt to explain these movements.
Right.
They provide a framework.
Sure.
But often, real-world currency dynamics are influenced by events that defy those neat theoretical explanations.
Like that time everyone panicked about, well, everything a few years back, and suddenly currencies were swinging wildly.
Yeah.
Speaking of wild swings, let's talk about the US dollar. It's been on a roller coaster ride from king to, well, not quite king over the past few decades.
The superdollar of the 1980s, fueled by high interest rates and a strong economy, attracted global investment like moths to a flame.
Yeah.
It seemed untouchable. But then came the dot-com bubble, the 2008 financial crisis. Even the mightiest currencies can stumble.
It's true. But here's the thing. Pronouncements of the dollar's demise have been greatly exaggerated, haven't they?
Absolutely. Laïdi emphasizes the dollar's resilience. It remains the world's leading reserve currency, adapting to crises and maintaining a pivotal role in global finance.
It's like that friend who always bounces back no matter what life throws their way.
Right.
And speaking of bouncing back, remember when commodity prices went through the roof around the turn of the millennium? Laïdi calls it a supercycle.
And it's a key piece of the currency puzzle. This surge wasn't just about one or two commodities. It was a broad-based boom across energy, agriculture, and metals, fueled by surging demand from emerging economies, particularly China.
So what you're saying is, while the US dollar is still a major player, the rise of these emerging economies is shifting the balance of power, and currencies are feeling the ripple effect.
Exactly. And this is where understanding those tangible things, the oil, the gold, the wheat, helps us understand why currencies move the way they do.
Okay.
Take the Australian and Canadian dollars, for example.
Those are heavily influenced by commodity exports, right?
Exactly.
When those prices soar, so do their currencies.
Right.
But it's not always that straightforward, is it?
Not at all. The currency market is like a giant game of Jenga.
Oh.
One wrong move can bring the whole tower down.
Right.
Take the carry trade, for example. Investors borrow in low-yielding currencies to invest in higher-yielding assets, often in commodity-driven markets.
Hold on, break that down for me. So I'm an investor, and I see a country with high interest rates. Maybe they're commodity rich, their economy is booming. I'm thinking, cha-ching easy money.
Right, but here's the catch.
Right.
You borrowed in a currency with low interest rates.
Yeah.
If the currency you invested in suddenly weakens against the one you borrowed in your profits, could vanish overnight.
Ouch. That's a risk I hadn't considered.
Huh.
Sounds like we need to be paying attention to something else. Laïdi calls the market's fear gauge, the VIX.
Right.
It's not just for stocks, is it?
Not at all. The VIX measures market volatility, and when it spikes, it's a sign that investors are getting jittery no matter what asset class they're trading. That fear ripples through everything, including currencies.
Okay, so we've got emerging economies shaking things up, commodities booming, and investors on edge. What's the one asset everyone seems to flock to when the going gets tough?
Goals, of course.
The ultimate safe haven, right?
Right.
But is it really that simple? I mean, gold prices fluctuate too, don't they?
They do. Laïdi digs into the complex relationship between gold and the US dollar.
Okay.
They often move in opposite directions. A weak dollar often translates to a stronger gold price.
So is gold a hedge against economic storms or just a barometer of broader anxieties? What I'm hearing is it's complicated.
It is. And to complicate things further, we have to consider the impact of the U.S. current account deficit, a persistent imbalance in the global economy that Laïdi argues has a huge effect on currency markets.
Okay, pause for a second. Current account deficit. For those of us who don't speak fluent economists, could you unpack that a bit?
Essentially, it means the U.S. spends more on foreign goods and services than it earns from its exports.
So if I'm constantly buying things from my neighbor, but they're not buying anything for me, eventually I'm going to be in trouble.
Exactly.
Yeah.
Now imagine that on a national scale, this imbalance has raised concerns about the sustainability of the dollar's dominance.
That's a lot to process. It sounds like we're talking about a potential power shift in the global currency landscape. Is the US dollar's reign coming to an end?
That's the million-dollar question, isn't it?
Right.
And while we can't predict the future, understanding these interconnected forces, from the rise of new economic powerhouses to the dynamics of commodity markets, is essential to navigating this complex world.
So it's not about finding a crystal ball, but about understanding the forces at play, right?
Precisely. And that's what we'll explore further in this deep dive. You know, it's fascinating how Laïdi compares understanding currency movements to a detective story. We need to uncover the clues and connect the dots.
I'm always up for a good mystery. And we've already got a few clues to work with. Emerging economies, commodities, that whole US current account deficit situation. Where do we even begin to untangle all of this?
Laïdi suggests we start by looking at historical precedents. Remember those central bank gold sales in the late 1990s?
Vaguely. Didn't they cause quite a stir in the gold market?
They did. Central banks, particularly in Europe, were offloading their gold reserves, and that combined with other factors sent gold prices plummeting. It was a time of significant uncertainty for the precious metal.
So what happened? Did gold eventually recover?
It did. But the interesting part is what it reveals about market psychology. The Washington Agreement on gold, reached in 1999, put a cap on those central bank sales, which calmed the markets and helped gold regain its footing.
So it wasn't just about the actual gold supply, it was about the fear and uncertainty that those sales created. When that fear subsided, so did the selling pressure on gold. It's a good reminder that psychology plays a huge role in markets.
Exactly. And while we often think of gold as this safe haven asset, its price is still subject to the same emotional waves as any other market.
Okay, so central bank actions can move the needle. But what about those mysterious figures we hear about, speculators? Laïdi talks about their influence on gold markets. Are they the ones pulling the strings?
Their role is definitely a point of debate. Laïdi presents data showing a correlation between the amount of gold held by speculators, those who are essentially betting on short-term price movements, and the actual price of gold.
So are they driving the trend, or are they just along for the ride, amplifying the moves that are already happening?
That's the million-dollar question, isn't it?
Right.
It's a bit of a chicken and egg scenario.
Yeah.
But here's the thing. Laïdi reminds us that the gold story is just one piece of a much larger puzzle.
Okay.
The commodity boom wasn't just about gold. It was a broad-based surge across various sectors.
Right. It's easy to get fixated on gold because of its history, and let's face it, its glamour. But it's not the only commodity making waves.
Exactly. And remember how we talked about currencies being tied to tangible things?
Right.
Well, if we want to understand those currency movements, we need to look beyond the shiny allure of gold and consider the impact of other commodities like oil.
Oil, the black gold that fuels our modern world. But how does it influence currency markets?
Think about it. Oil is priced in US dollars.
Okay, yeah.
When the dollar weakens, oil becomes more expensive for countries using other currencies. This can lead to inflation, trade imbalances, and even political instability.
Wow, I never considered how a weak dollar could impact things like political stability. Tell me more about that.
Well, imagine a country heavily reliant on oil imports. A sudden surge in oil prices driven by a weakening dollar could cripple their economy, leading to social unrest and political instability.
That's a domino effect I hadn't considered. So a weak dollar means expensive oil, which can trigger a whole cascade of economic and political headaches around the world. It makes you realize how interconnected everything really is.
It is. And it highlights why understanding these commodity dynamics is essential to understanding the global currency game.
Speaking of interconnectedness, we can't ignore the elephant in the room. The U.S. current account deficit, Laïdi calls it a persistent feature of the global economy. That doesn't sound particularly reassuring, does it?
It's definitely a source of concern. Remember our analogies of spending more than you earn?
Oh, yeah.
The U.S. current account deficit reflects that imbalance on a national scale.
Right. Buying more from the world than we're selling. But how does this impact the dollar? Does it mean the U.S. is heading for financial ruin?
Laïdi explores the various factors contributing to this deficit, from trade imbalances to government spending. He also examines the potential consequences for the dollar's long-term dominance as the world's reserve currency.
So it's not a simple case of the U.S. going bankrupt, but this deficit does raise questions about the dollar's staying power.
Exactly. And this is where Laïdi introduces a thought-provoking concept, the idea of a potential shift in the global currency landscape.
Yeah.
He suggests that the euro, backed by a strong European economy and a credible central bank, could emerge as a viable alternative to the dollar.
A euro challenger to the dollar throne? That would be a seismic shift. What makes Laïdi think that's even a possibility?
He points to several factors. First, the Eurozone has a larger economy than the US.
Okay.
Second, the euro is already widely used in international transactions. And third, some central banks are diversifying their reserves away from the dollar and into euros.
So we're potentially talking about a multipolar currency world where the dollar might have to share the stage. That's a big deal.
It is. And Laïdi highlights how this potential power shift is further intertwined with the commodity boom, particularly the surge in oil prices.
What do oil prices have to do with the euro challenging the dollar?
Right now, oil is priced solely in US dollars. But imagine a scenario where oil is priced in a basket of currencies, including the euro. That would significantly diminish the dollar's dominance and create a more level playing field in the global currency market.
Okay, that would be a game changer. Imagine the ripple effects if oil, the lifeblood of the global economy, were no longer tethered to the dollar.
It's a fascinating scenario to consider. And Laïdi underscores how these interconnected forces, currency movements, commodity cycles, and the rise of new economic powers are reshaping the global financial order right before our eyes.
It's like watching a geopolitical chess match unfold in real time. And speaking of powerful players entering the game, Laïdi also discusses sovereign wealth funds. Those are those massive investment funds controlled by governments, right?
Yes. They're becoming increasingly influential in global markets.
Yeah.
Many are flush with oil money and are diversifying their holdings away from traditional investments like U.S. Treasuries.
So they're not just parking their money in U.S. dollars anymore. Where are they investing instead?
They're exploring opportunities in other markets, especially those driven by, you guessed it, commodities. Right.
So it's not just about central banks and speculators anymore. These sovereign wealth funds are flexing their financial muscles too. How does that impact currencies?
Their investment decisions can have a significant impact on currency valuations. When a sovereign wealth fund decides to pour billions into a particular country or asset class, it creates a demand for that country's currency, which can cause it to appreciate.
It's like a financial game of musical chairs. Everyone's scrambling for a seat at the commodity table, and currencies are getting tossed around in the process.
A fitting analogy. And Laïdi emphasizes how these shifting investment flows driven by the commodity boom and the search for higher returns are creating new winners and losers in the currency market.
Winners and losers, it's like a global financial competition playing out on a massive scale. So given all of this complexity, is it even possible to make sense of it all? Can we predict where currencies are headed?
Laïdi acknowledges the inherent difficulty in predicting currency movements with certainty. There are simply too many variables at play.
Right.
But he doesn't leave us completely adrift.
So there's hope for us yet. What's Laïdi's advice for navigating this intricate landscape?
He stresses the importance of understanding the underlying forces shaping these markets from macroeconomics to commodity cycles. It's about recognizing patterns, identifying trends, and developing a framework for analysis.
So it's not about finding a crystal ball, but about developing a deeper understanding of the game itself.
Precisely. And that understanding starts with recognizing that currencies are not just abstract units of exchange. They reflect the ebb and flow of global power, the interconnectedness of economies, and the tangible realities of a world driven by commodities.
It's a reminder that economics is about more than just numbers. It's a story of human behavior, geopolitical forces, and the constant pursuit of wealth and stability in a world of uncertainty.
Well said. And as we delve deeper into this story, Laïdi provides some valuable tools to help us decipher those currency currents and commodity surges.
Tools, you say? Now you've piqued my interest. What kind of tools are we talking about?
Well, he revisits the concept of yield curves, those charts that track the relationship between short-term and long-term interest rates.
Right, yield curves. We touched on those earlier when we were talking about the Fed's interest rate decisions, but how exactly do they help us understand currency movements?
Laïdi points out that yield curves can act as early warning signals for economic downturns. Specifically, he highlights the phenomenon of yield curve inversions, where short-term interest rates rise above long-term rates.
Inversions? That doesn't sound good. What causes them?
It's a complex interplay of factors, but essentially it suggests that investors are losing confidence in the long-term economic outlook. They're demanding a higher return for tying up their money in long-term bonds, which drives up those short-term rates.
And historically, what happens when those yield curves invert?
Unfortunately, it's often a precursor to a recession. And when an economy stumbles, its currency usually takes a hit as well.
Ah, so it's like a canary in the currency coal mine. When the yield curve inverts, it's time to batten down the hatches and brace for impact.
In a sense, yes. Laïdi even presents a chart in his book showing how these inversions have coincided with periods of US dollar weakness. It's a pretty compelling visual representation of that connection.
I always appreciate a good chart. So yield curves are one tool in our currency decoding kit. What else should we be keeping an eye on?
Well, Laïdi delves into a fascinating analysis of the relationship between US politics and the dollar.
Wait, you're telling me that who occupies the White House can actually move currency markets?
Believe it or not, it's true. Laïdi presents compelling data showing that presidential elections, congressional control, and even the backgrounds of Treasury secretaries have historically impacted the greenback's performance.
So it's not just about economic indicators, it's about politics too. That adds a whole other layer of complexity.
Exactly. For example, Laïdi points out that Treasury secretaries with strong Wall Street ties have often overseen periods of dollar strength. They're seen as more business-friendly and likely to implement policies that benefit the financial markets.
That makes sense. They know how to play the financial game. But what about those times when the political winds shift dramatically? Does that always spell trouble for the dollar?
Not necessarily. Laïdi analyzes various political scenarios, from periods of bipartisan cooperation to times of heightened partisan gridlock. He concludes that the dollar's performance is often influenced by the perceived stability and predictability of U.S. politics.
So it's not just about which party is in power, but about the overall political climate. A stable and predictable political system tends to inspire confidence in a country's currency.
Precisely. Uncertainty breeds volatility. And as Laïdi emphasizes understanding, these political dynamics can add another layer of insight into potential currency movements.
It's like a reminder that economics is intertwined with politics, history, and even psychology. To really understand how these markets work, you need to be a bit of a historian, a political scientist, and even an amateur psychologist.
Absolutely.
Yeah.
And Laïdi doesn't shy away from acknowledging the complexity of this interplay. He even examines how periods of economic uncertainty, political turmoil, and geopolitical events can all converge to create major currency swings.
It's enough to make your head spin. So many factors influencing these markets, it can feel overwhelming.
It can be. But remember, there are patterns, relationships, and historical precedents that can help us navigate these choppy waters.
So we're not just blindly guessing. We can use these tools and insights to make more informed decisions. But let's be honest, sometimes it feels like these markets have a mind of their own.
They often do. But even amidst the chaos, there are opportunities for those who are paying attention. That's why Laïdi stresses the importance of staying informed, keeping a close eye on global events, and constantly updating our understanding of the forces shaping these markets.
It's like we're financial detectives piecing together the clues to solve the mystery of the ever-shifting currency landscape. What other clues does Laïdi offer up?
He takes a deep dive into the commodity supercycle itself, exploring the factors behind its remarkable persistence.
Right. We talked about the commodity boom earlier, but now we're really getting into the nitty-gritty.
Yes, exactly. Laïdi breaks down the supercycle by individual commodity groups, analyzing the specific drivers and trends within each sector. He starts with the energy markets, where oil, as always, takes center stage.
Of course, oil, the fuel that powers the world. What insights does Laïdi offer on the oil market?
He begins by comparing the current commodity cycle to previous ones. He notes that this one is not only longer in duration, but also broader in scope, encompassing a wider range of commodities.
So we're not just talking about an oil boom, it's a full-blown commodity party across the board.
Precisely. And Laïdi emphasizes that this breadth and persistence are largely driven by structural changes in the global economy, particularly the rise of emerging markets like China.
Right, we've touched on China's insatiable appetite for commodities, but I'm curious to dig deeper. How is their demand specifically shaping the oil market?
Laïdi points to several factors, including their rapid industrialization and urbanization, which require massive amounts of energy. But it's not just about factories and power plants anymore. China's burgeoning middle class is also driving demand.
So it's about millions of Chinese families hitting the road in their new cars, fueling up their tanks and driving up demand for oil.
Exactly. Laïdi highlights how this shift in consumption patterns is a key driver of the oil price surge. He even points out how China's oil imports have skyrocketed in recent years, making them a dominant force in the global market.
So China's no longer just the world's factory, it's also becoming the world's gas station.
In a sense, yes. And Laïdi underscores how this shift in global demand patterns is unlikely to reverse anytime soon, which means upward pressure on oil prices is likely to persist.
Okay, so we've got China's booming economy driving oil demand, but what about the supply side? Are we running out of oil?
That's the billion-dollar question, isn't it? Laïdi addresses it head-on, analyzing the various factors influencing oil supply, from geopolitical tensions in oil-producing regions to the depletion of existing reserves.
Right, we've all heard about those peak oil theories, the idea that we're running out of easily accessible oil.
Laïdi examines those theories in detail. He also explores the potential for new discoveries and technological advancements to increase oil production. He even delves into the role of OPEC, the cartel of oil-producing nations, in managing global supply.
OPEC, those folks who always seem to be at the center of the oil price drama, how much power do they really wield?
Laïdi provides a historical overview of OPEC's actions, from their embargoes in the 1970s to their more recent attempts to stabilize prices. He notes that their production decisions can have a significant impact on global markets.
But it's not always that straightforward, is it?
Right. OPEC's role has become increasingly complex in recent years as they navigate the competing interests of their member nations and the unpredictable dynamics of global demand.
So it's not just a simple case of OPEC turning the oil spigot on and off as they please. They're also caught in the cross-currents of geopolitics and market forces.
Exactly. And Laïdi emphasizes that understanding OPEC's dynamics is essential to deciphering the oil market puzzle. It's a reminder that oil is more than just a commodity. It's a geopolitical chess piece with the power to move markets and shape economies.
And as we've been discussing, those market moves and economic shifts inevitably impact currencies. It's all connected.
Absolutely. But the commodity supercycle isn't just about oil, even though it often grabs the headlines. Laïdi also delves into the fascinating world of metals.
Metals, that's a pretty broad category. What specific metals are we talking about here?
Laïdi focuses on those metals that have played a key role in the supercycle, from industrial metals like copper and aluminum to precious metals like gold and silver.
Gold, our old friend. But why are these metals experiencing such a boom? Is it just a spillover effect from the oil surge?
It's a bit more nuanced than that. Laïdi explores the specific drivers behind each metal's price movements, noting that while there are some common factors, each metal has its own unique story.
Okay, so let's start with the industrial metals, copper and aluminum. What's fueling their rise?
Laïdi points to the robust demand from emerging economies, particularly China. Think about all the infrastructure projects and manufacturing activities happening in China. They require massive amounts of copper and aluminum.
Right, China, the construction crew of the global economy. They seem to need a constant supply of steel, copper, and everything in between.
Precisely. And Laïdi highlights how this demand has strained global supply chains, leading to higher prices for industrial metals. He also examines the role of supply disruptions, from labor strikes to natural disasters, in exacerbating these price pressures.
So it's a classic case of supply and demand. China's booming economy is creating a global metal shortage, driving up prices.
In a nutshell, yes. And Laïdi emphasizes that this imbalance is unlikely to disappear anytime soon, as China's growth shows no signs of slowing down.
Okay, so industrial metals are hot commodities thanks to China's insatiable appetite. But what about the precious metals, gold and silver? What's driving their shine?
Laïdi delves into the factors behind gold and silver's price movements, noting that they're often driven by a different set of dynamics than industrial metals.
Right. Gold has always been seen as that safe haven asset, something people flock to during times of uncertainty, whether it's economic turmoil, political instability, or even natural disasters.
Exactly. Laïdi explores how gold's role as a hedge against inflation. Economic turmoil and geopolitical risk has contributed to its price surge.
But it's not just about fear and uncertainty, is it?
Right. Laïdi also examines how central bank policies, particularly those aimed at stimulating economies through quantitative easing, have fueled demand for gold as an alternative to fiat currencies.
Quantitative easing. Can you refresh my memory on that one? It's one of those terms that always makes my head spin a little.
Essentially, it's when central banks inject money into the financial system by buying assets like government bonds. The idea is to lower interest rates and encourage borrowing and spending.
Okay, that's starting to ring a bell. But how does that impact gold?
Well, when central banks print more money, it can lead to inflation. And historically, gold has been seen as a good hedge against inflation because its value tends to rise when the purchasing power of fiat currencies declines.
So it's like a self-fulfilling prophecy. Central banks print more money, people worry about inflation, and they buy gold, which drives up its price.
You got a scaff. Laïdi also examines the role of investment demand in driving gold and silver prices, noting that these metals have become increasingly popular as portfolio diversifiers.
Right, it's not just about people burying gold bars in their backyard anymore. Even big institutional investors are adding gold to their portfolios.
Exactly. And Laïdi points out that this increased investment demand has contributed to the sustained rally in precious metals. Of course, we also have to factor in the role of speculators who can amplify price swings with their short-term trading activities.
Speculators, those folks who thrive on market volatility. It seems like they're always lurking in the background, ready to capitalize on any opportunity.
True. But as Laïdi reminds us, while speculators can influence short-term price movements, they're not the fundamental drivers of the commodity supercycle. Those are driven by bigger, more structural forces, global demand-supply constraints, and macroeconomic trends.
So it's like the difference between the waves on the surface of the ocean and the powerful currents deep below. The waves might be what we see and feel, but those deep currents are what's really driving the action.
Exactly. And as we continue our exploration of the supercycle, Laïdi takes us beyond the energy and metals markets, delving into the realm of agriculture.
Agriculture. Now we're talking about food, right?
Yeah.
But how does that fit into the commodity boom?
It's a crucial piece of the puzzle. Laïdi examines how agricultural commodities, from grains like wheat and corn to soybeans and other food crops, have experienced a remarkable price surge in recent years.
So it's not just about filling our gas tanks and building our skyscrapers. It's also about putting food on the table. What's driving this surge in agricultural prices?
Laïdi points to a confluence of factors, starting with rising global demand for food. As populations grow and incomes rise, particularly in emerging markets, people are demanding more and better food.
That makes sense. But it's not just about more mouths to feed, is it?
Right. Another significant factor is the increasing use of crops for biofuel production.
Biofuels? Isn't that when we turn corn into ethanol to power our cars?
Exactly. And as demand for biofuels has increased, it's diverted crops away from food production, putting upward pressure on agricultural prices.
So we're essentially competing with our cars for food now. That's a sobering thought.
It is. And then, of course, we have to factor in unpredictable events like weather patterns, which can significantly impact crop yields and prices.
Right. Droughts, floods, early frosts. All of these can wreak havoc on agricultural production.
Absolutely. And on top of all of that, we have geopolitical events and trade policies, which can further disrupt agricultural markets.
It's a lot to juggle, so it's not just about supply and demand. It's about a complex interplay of factors: global demand, biofuels, weather politics, all shaping the price of our food.
Precisely. And Laïdi emphasizes that this agricultural boom has significant implications for currencies, particularly those of countries that are major exporters of agricultural commodities.
Right, we talked earlier about those commodity-driven currencies like the Australian and Canadian dollars. Are they also being impacted by this agricultural surge?
Absolutely. Laïdi explores how these currencies, as well as others like the Brazilian real and the New Zealand dollar, have been influenced by the rise in agricultural commodity prices.
So it's truly a global phenomenon. Currencies around the world are being impacted by these commodity surges. But it's not just a one-way street, is it? We were talking about how currency movements can also influence commodity prices. Can you elaborate on that?
Of course. Remember how we talked about oil being priced in US dollars? Well, when the dollar weakens, it makes commodities like oil more expensive for buyers using other currencies.
Because they have to exchange more of their currency to get those US dollars to buy the oil.
Exactly. And this increased demand for those commodities can further drive up their prices, which creates a sort of feedback loop.
So a weak dollar can actually fuel a commodity price surge, which can then further weaken the dollar. It's like a vicious cycle.
Precisely. And Laïdi examines how this dynamic has played out in recent years, particularly with the US dollar and oil prices. He notes that as the dollar has weakened, it's made oil more expensive for countries using other currencies, which has contributed to the global oil price rally.
So it's not just China's demand driving oil prices. The weak dollar is playing a role too. It's like a perfect storm of factors converging to push those prices higher.
It is. And Laïdi emphasizes that understanding this complex interplay between currency movements and commodity prices is essential to making sense of the global financial landscape.
It's a reminder that these markets are interconnected in incredibly complex ways. Currencies, commodities, geopolitics, investor psychology, they all influence each other.
Well said. And as we delve deeper into Laïdi's analysis, he'll provide valuable insights into how to decipher these intricate connections and navigate this challenging but fascinating terrain.
I'm ready for the challenge. What else does Laïdi explore in his book?
Well, he takes us beyond just understanding these market dynamics and delves into specific currency plays, examining how different currencies have been impacted by the commodities supercycle and other global trends.
Currency plays. Sounds like we're getting into the strategic side of things. I'm ready to level up my currency game.
Excellent. Laïdi provides some valuable insights into how investors and traders can potentially capitalize on these currency movements. He highlights the opportunities, but also the risks associated with different currency pairs.
Okay, I'm all ears. What kind of currency plays does he discuss?
He starts by examining a popular strategy known as the carry trade.
Carry trade. That rings a bell. Didn't we touch on that earlier when we were discussing risk appetite and currency flows?
Exactly. It's a strategy that takes advantage of interest rate differentials between currencies. Investors borrow in a low-yielding currency and then invest in a higher-yielding one, hoping to profit from the difference in interest rates.
Right. So I borrow money in a currency with low interest rates, say the Japanese yen, and then I invest that money in a currency with higher interest rates like the Australian dollar. And as long as the Australian dollar holds its value against the Japanese yen, I'm making a profit on that interest rate differential.
You got it. And this is but there are risks involved.
You okay?
If the currency you invested in suddenly weakens against the one you borrowed in your profits, could vanish overnight, and you could even end up losing money.
Right, high risk, high reward. That seems to be a recurring theme in the world of currency trading.
It definitely is. And Laïdi stresses that successful carry trades require careful analysis, risk management, and a deep understanding of the factors influencing currency valuations.
So it's not as simple as just chasing the highest interest rates. You really need to do your homework.
Exactly. And while the carry trade can be a tempting strategy, it's not the only game in town. Laïdi also explores other currency strategies, such as those based on fundamental analysis, technical analysis, and even sentiment analysis.
Okay, break those down for me. What exactly are fundamental analysis, technical analysis, and sentiment analysis?
Good question. Fundamental analysis involves studying economic indicators, government policies, and other factors that can impact a currency's intrinsic value.
So if I'm using fundamental analysis to decide whether to buy or sell a particular currency, I might look at things like a country's GDP growth, inflation rates, or unemployment figures.
Exactly. You're trying to assess the underlying strength or weakness of a country's economy, which will ultimately be reflected in its currency's value.
Okay, that makes sense. So what about technical analysis? What's that all about?
Technical analysis, on the other hand, focuses on charting patterns, historical price movements, and other market data to try to predict future price direction.
So instead of trying to understand the underlying economic fundamentals, technical analysts are more interested in the charts and what they can tell us about investor behavior and market sentiment.
Exactly. They're looking for patterns and trends that can give them an edge in predicting where the market might be headed.
Okay, and then there's sentiment analysis. What's that all about?
Sentiment analysis is all about gauging the overall mood of the market. Are investors feeling optimistic or pessimistic? Are they bullish or bearish on a particular currency?
So it's about trying to tap into the collective psychology of the market.
Precisely. And while it might sound a bit touchy-feely, sentiment analysis can be a powerful tool for traders.
Okay, so we've got fundamental analysis, technical analysis, and sentiment analysis. It sounds like a lot to keep track of.
It can be. Laïdi explains how each of these approaches involves analyzing different sets of data and indicators to identify potential currency trends and trading opportunities. But he also emphasizes that no single approach is foolproof.
So there's no magic formula or one-size-fits-all approach to currency trading.
Unfortunately not. Successful currency trading often requires a combination of strategies, a willingness to adapt to changing market conditions, and a healthy dose of risk management.
It's about being flexible, adaptable, and constantly learning. You can't be afraid to adjust your strategies as the market changes.
Exactly. And Laïdi stresses the importance of staying informed, conducting thorough research, and developing a deep understanding of the forces shaping currency markets. He even provides some practical tips on how to manage risk, set realistic expectations, and avoid common trading pitfalls.
Okay, we've got our strategic playbook, but how do we put these strategies into practice? How do we actually identify specific currency plays?
Well, Laïdi dives into a series of case studies examining how different currency pairs have performed in recent years and highlighting the factors driving those movements.
Case studies, I love a good case study. It's like getting a behind-the-scenes look at how these markets actually work in the real world.
Exactly. Laïdi starts with perhaps the most important currency pair in the world, the euro-dollar pair. He examines how the euro has strengthened against the dollar in recent years.
Right. We talked about that earlier. The euro seems to be gaining ground on the dollar. What does Laïdi attribute that to?
Well, he points to several factors, including the European Central Bank's monetary policies,
Okay.
the Eurozone's economic recovery since the last financial crisis,
Right.
and of course that persistent U.S. current account deficit we keep talking about.
Right. Those factors are putting downward pressure on the dollar and giving the euro a boost. But does Laïdi think this trend will continue?
He explores that possibility, but he also cautions that currency markets are notoriously difficult to predict.
Right.
There are always risks involved.
It's like they say, past performance is not indicative of future results. What other currency pairs does Laïdi examine?
He analyzes the dollar-yen, the pound-dollar, and the Australian dollar-US dollar, always highlighting the unique factors influencing their movements and identifying potential trading opportunities or at least things to watch for.
So it's a global currency tour. Laïdi is giving us a glimpse into the dynamics of different currency markets around the world.
Exactly. And what's fascinating is how he emphasizes that each currency pair has its own unique story.
Right.
There's no one-size-fits-all approach to analyzing these markets. You really need to understand the specific factors driving each currency.
And it's not just about economic data, right? Geopolitical events, natural disasters, even a surprise announcement from a central bank, all of these things can send currencies soaring or plummeting.
Absolutely. Currency trading is not just about numbers on a screen. It's about understanding the forces shaping the global economy, politics, and even human psychology.
It's about connecting those dots, the economic data, the political events, the whispers of fear or exuberance rippling through the markets. It's a lot to take in.
It is. And Laïdi doesn't shy away from the complexity of it all, but he also reminds us that with knowledge comes opportunity.
Okay, so we've covered a lot of ground here. We've talked about the history of currency markets, the commodity supercycle, and even some specific strategies that traders use to navigate this intricate landscape. As we start to wrap things up, what are some of the key takeaways from Laïdi's book?
One of the biggest is this. The days of the US dollar reigning supreme are numbered.
Okay.
We're moving towards a multipolar currency system.
That's a pretty bold statement. What makes Laïdi so sure that's where things are headed?
He points to several factors, including the growing economic cloud of emerging markets, the increasing use of alternative currencies in international trade, and even the rise of digital currencies.
Right. We haven't even touched on cryptocurrencies yet, and they're certainly shaking things up in the financial world. Does Laïdi see them playing a major role in this new multipolar system?
He acknowledges their potential to disrupt the financial status quo, but he also emphasizes that it's still early days.
Right.
It remains to be seen which digital currencies, if any, will gain widespread adoption and how governments will choose to regulate this rapidly evolving space.
So while cryptocurrencies are definitely a wild card in the future of finance, it's too early to tell what their long-term impact will be.
Exactly. But regardless of what happens with crypto, Laïdi is clear that the currency landscape is shifting.
So what does this all mean for the average person? What can we do to navigate this increasingly complex and uncertain world?
Laïdi stresses the importance of diversification. Don't put all your eggs in one basket, whether it's one currency, one asset class, or one geographic region.
So spread the risk. Don't bet the farm on any one outcome.
Exactly. He also encourages investors to explore opportunities in emerging markets,
Which can offer higher growth potential, but also come with higher risk.
Right. That's why Laïdi emphasizes the importance of doing your homework.
Yeah.
Research those markets, understand the risks, and perhaps consult with a financial advisor who specializes in those regions.
Okay, so diversification and exploring emerging markets. Any other advice for those of us who aren't seasoned currency traders?
Laïdi suggests considering exchange-traded funds or ETFs, which can provide exposure to a basket of currencies or commodities, making it easier for individuals to diversify their portfolios without needing to become experts in currency trading.
Right, ETFs are a great tool for investors of all levels because they make it easy to invest in a diversified portfolio of assets without having to buy and sell individual stocks or bonds.
Exactly. But even if you're using ETFs, it's important to understand what you're investing in, the fees involved and the risks involved.
Always read the fine print, right?
Absolutely. And beyond specific investment strategies, Laïdi emphasizes the importance of being an informed citizen of the world.
Okay.
Stay up to date on global events, economic trends, and central bank policies.
That sounds like a lot to keep track of. Where can we go for reliable information?
Laïdi suggests following reputable financial news sources, reading economic reports, and even attending seminars or webinars to deepen your understanding.
So never stop learning. The currency game is constantly evolving, so we need to evolve along with it.
Exactly. And that's what makes this all so fascinating. Currency markets are like a window into the inner workings of the global economy. By understanding these dynamics, we gain a deeper appreciation for the forces shaping our world.
It's like a giant puzzle, and we've been piecing together the clues this entire episode. We've learned about the history of currencies, the impact of commodities, the rise of emerging markets, and the strategies that traders use to navigate these volatile waters.
And while we might not all become expert currency traders, understanding these dynamics empowers us to be more informed investors and more engaged citizens of the world.
Well said. It's about recognizing those connections between the headlines and our own lives, understanding how global events and economic trends impact everything from the price of our morning coffee to the value of the money in our bank accounts.
Absolutely. And as Laïdi reminds us, we're all part of this interconnected global system, whether we realize it or not.
Well, on that note, I think we've done a pretty deep dive for today. For those who want to explore this subject further, I highly recommend checking out Ashraf Laïdi's book, Currency Trading and Intermarket Analysis. It's packed with valuable insights, and he has a knack for explaining complex topics in a clear and engaging way.
I agree. It's a great read for anyone who wants to understand how currency markets really work.
So as we wrap up this deep dive, I want to leave you with this thought. The world of finance might seem intimidating, but it doesn't have to be. By taking the time to educate ourselves, we can all become more informed and empowered participants in the global economy.
Well said. And remember, knowledge is power. The more you understand about the forces shaping the world around you, the better equipped you'll be to navigate whatever challenges and opportunities come your way.
Absolutely. Thanks for joining us on this deep dive into the fascinating world of currency trading. Until next time, keep exploring, keep learning, and keep diving deep.